Today, we're continuing our journey of learning accounting with the first step of the 9-step accounting cycle, analyzing business transactions. There are a few ways accountants analyze business transactions, and one is by using the accounting equation. That's what we'll focus on today. In part one, which I linked above, we talked about Eli's Consulting Services, a brand new service business founded by Trade and Eli. The first 6 transactions we learned about in part one were all about getting the business ready for new clients, such as buying equipment, renting space, and hiring employees. In part two, we are learning about 6 additional transactions that are common to service businesses, from recording revenue, customer payments, expenses, and withdrawals by the owner called drawings. In addition, we'll prepare a complete set of financial statements based on the 12 transactions for Eli's Consulting Services. Let's start with revenue. Every business needs revenue, or before long, there won't be a business any longer. The definition of revenue or income is the inflow of money or other assets that result from the sale of goods or services or use of money or services. When a sale occurs, the revenue increases assets, which is either cash for a cash sale or accounts receivable for an on-credit sale, and increases owner's equity. Why owner's equity? Well, the owner established the business and invested money. Any profits or losses, for that matter, the business produces belong to the owner. Revenue recognition can be a very complicated accounting topic, especially for businesses in the software industry, where software is licensed for a specific period of time, but also for businesses that sell goods that are connected with future promises for other products, like buy this product and you'll receive 20% off on your next purchase. It is a fascinating area to work in. I've worked for several businesses where revenue recognition was a big topic, and I certainly learned a lot about the business from just that work. However, for our discussion today, we're keeping it simple because you're learning the basics first. Walk before you run, so to speak. Transactions 7 and 8 are about recording revenue for Eli's Consulting under 2 different scenarios. In the 7th transaction, the client pays right away, whereas in the 8th transaction, Trade and Eli extends credit to customers. So let's start with the cash revenue scenario first. During the month of December, Eli's Consulting earned a total of $36,000 in revenue from clients who paid cash for accounting and bookkeeping services. The customers paid cash, which means that the cash account increased. Trayton took the cash, probably checks, and deposited them into the business's bank account. We record that increase in cash in our accounting equation by writing plus $36,000 into the cash column. Don't forget, every business transaction has at least 2 parts. That is why accounting is also called double entry bookkeeping. So for part 2 of this transaction, we need to focus on the fact that revenue also increased. To keep things organized, we add another category within the owner's equity section that we'll call revenue, and we'll write plus $36,000 into that column. Let's double check that our accounting equation still balances. Cash $119,000 plus supplies $1,500 plus prepaid rent $8,000 and equipment $11,000 for total assets of $139,500. On the right side of the accounting equation, we have liabilities of $3,500 and owner's equity of $100,000 and revenue of $36,000 for a total of $139,500. That confirms that our accounting equation is still in balance. In the 8th business transaction, Eli's Consulting earned $11,000 of revenue from charge account customers. That means that these clients are allowed extra time to pay the invoices, probably 30 days. That's a pretty typical time period for an on-account sales or service invoices. Accounts call monies owed by customers accounts receivable. And to keep things organized for Eli's Consulting, we'll add another category called accounts receivable to the accounting equations asset side. And we're now ready to analyze this transaction. What happened? For one, customers now owe Eli's Consulting $11,000. We'll record that by entering $11,000 into the accounts receivable column. What about the second part of the transaction? Well, Eli's Consulting now has more revenue, and we need to record that too. So we'll write plus $11,000 into the revenue column as well. After we add up each column, we can see that both sides of the equation show a total of $150,500, and they still balance. Customers owe a business money, they will eventually pay, and hopefully sooner than later. In the ninth transaction, we record the customer payment when Eli's Consulting received $6,000 on account from clients who owed money for services previously billed. The customer gave Eli's Consulting cash and Triton deposited the money, so that bank account now shows more cash. We need to record that in our accounting equation by writing plus $6,000 into the cash column. For part two, because we always need at least two parts for every transaction we record, we need to record that our accounts receivable have now decreased. Why? Well, the customer paid and they now owe less money to Eli's Consulting. So let's record that by writing minus $6,000 into the accounts receivable column. And as we've done before, we calculate the new totals for each column and double check that the two sides of our equation still balance. Here we have $150,500 on the left side and $150,500 on the right side. And that means that we're still in balance. Let's now look at expenses. The definition of expenses is the outflow of money, the use of other assets, or the incurring of a liability. Common examples include rent, salaries, utilities, and raw materials. Expenses decrease owner's equity. Do you recall that I mentioned that all profits and losses of the business belong to the owner? That is why expenses decrease owner's equity. For the 10th transaction, we're going to record the salaries that Eli's Consulting paid for the accounting clerk and Sergio Sanchez. For part one of this transaction, the cash decreased because Eli's Consulting issued checks to the accounting clerk and Sergio. So let's record that part by writing minus $8,000 into the cash column. For part two, we need to record that the business now has expenses. To keep things organized for Eli's Consulting, we'll add a new category called expenses to the accounting equation's right side, part of owner's equity. Let's write plus $8,000 into that column. Let's spend a moment, though, in looking at the header where it shows Triton Eli's capital plus revenue minus expenses. So even though we wrote plus $8,000 into the expense column, in the total column, it's actually a negative amount because it reduces revenue. That is a little tricky, I admit. Let's add up our columns and double check that both sides of the equation still balance. 142,500 on the left side and 142,500 on the right side. We're in balance and ready to move on to the next transaction. The 11th transaction is very similar to the prior one. Eli's Consulting issued a check for $650 to pay the utility expenses. The cash decreased by $650, so let's write minus $650 into the cash column. And because we always need at least two parts for every transaction because of double entry bookkeeping, we need to also record that the expenses increased by $650. So let's write plus $650 into the expense column. Let's add up our columns, enter the new totals for each column and for each side of the accounting equation. Our new totals are $141,850 on the left as well as on the right side. We're now going to talk about another type of payment, but this one is for the owner of the business. When the owner withdraws money from the business, we call that a drawing. It is basically the reverse of an investment. The owner takes money for personal expenses or other assets of the business for personal use. Drawings reduce owner's equity. Let's now look at our last transaction. On December 30th, Eli withdrew $5,000 in cash for personal expenses. Withdrawals are not a business expense, but a decrease in the owner's equity. We record the two parts of this transaction by first writing minus $5,000 into the cash column because the business now has less cash. Next, for part two, we write minus $5,000 into the capital column because Trayton Eli now has less money invested in the business. We total the columns on both sides of the equation and see that we have cash of $111,350, accounts receivable 5,000, supplies 1,500, prepaid rent 8,000, and equipment 11,000, for a total of $136,850 on the left side of the accounting equation. On the right side, we have liabilities of $3,500, capital of $95,000, plus revenue of $47,000, and minus expenses of $8,650 for a total of $136,850, and we're still in balance. My recommendation is to write down these business transactions like I have done here so that you can refer to them whenever you need them. There are a limited number of transactions that occur all the time, over and over again, with some variations, of course, in terms of amounts and details. However, the basic concepts are the same. So think of this as learning the vocabulary for a foreign language. Flashcards might help you as well. There is no need to struggle with these basic transactions. Write these transactions down and refer to them as you complete your homework problems, and you can continue adding more information to it as we learn about debits and credits. Let's now talk about financial statements, which are reports that summarize the financial activities and position of a business. Said differently, they report the revenue and expenses, as well as what the business owns, what it owes to third parties, and what it owes to the owner of the business. Businesses typically prepare at least an income statement, a balance sheet, and a statement of owner's equity. However, it is common to also prepare a statement of cash flows, which shows the financial statement users the cash inflows and outflows of the business. The next step after we analyze the business transactions for Eli's Consulting is to prepare a standard set of financial statements. Preparing financial statements is one of the accountant's important jobs. Many business decisions are made based on the information in financial statements, and investors rely on the financial statements of publicly traded companies. Business managers and owners use the balance sheet and the income statement to control current operations and plan for future decisions and investments. Creditors, prospective investors, governmental agencies, and others are interested in the profits of the business and in the asset and equity structure as well. There's a specific order in which financial statements are prepared. We first prepare the income statement, then the statement of owner's equity, and finally the balance sheet. The income statement shows the results of the business's operations for a specific period, such as a month, a quarter, or a year. One company I worked for, Baja Fresh, reported their financials on a 4-4-5 basis, which meant that the first and second period was for 4 weeks, and the third was for 5 weeks. primarily because weekly sales comparisons were important to this business. All the other companies I worked for reported their financials on a monthly basis. The income statement shows the revenue earned and the expenses of doing business. Companies often report their revenue and expenses for a calendar year, but some companies choose a different fiscal year, like for instance from July 1st to June 30th. The income statement is sometimes called a profit and loss statement or a statement of income and expenses. The income statement starts with the header section where we list the name of the business, the name of the financial statement, and the time period on the third line. In the body of the income statement, we list the revenue and the expenses for the business and calculate the net income or profit by subtracting the expenses from the revenue. Now that we know the income or profit of the business, we can prepare the statement of owner's equity. That's right. You can't prepare the statement of owner's equity until you finish the income statement. We complete the header of the statement of owner's equity by writing the name of the business, the name of the financial statement, and the time period on the third line. The statement of owner's equity reports the changes that occurred in the owner's financial interest during the reporting period. In the body of the statement, we start with the beginning capital balance of $100,000, which Trade and Eli contributed to the business in November. The income or profits belong to the owners of the business, and we list that on the next line, but subtract any money that the owner took out of the business as drawings. We tally up the net income minus the drawings and write that amount of $33,350 as increase in capital on the next line. The next step is to add that amount to the $100,000 capital and the ending capital as of December 31st for a total of $133,350. Next up is the balance sheet. Why is the balance sheet last? Because we need the ending capital balance from the statement of owner's equity to complete the balance sheet. Balance sheet reports a business's financial condition as of a certain date, like for instance, as of December 31st. The balance sheet shows what the company owns and what it owes to third parties or the owners of the business, in short, the assets, liabilities, and owner's equity of the business. Eli's Consulting lists its assets of cash, $111,350, accounts receivable, $5,000, supplies, $1,500, prepaid rent, $8,000, and equipment, $11,000, for a total of $136,850 in assets. On the right side of the balance sheet, Eli's Consulting shows the liabilities for accounts payable of $3,500 and owner's equity of $133,350 for a total of $136,850. And we're still in balance. I once read that the most frequently asked question by accountants is, does it balance? Followed by, is there a variance? There might be some truth to that. What we have here is a relatively simple set of financials. It includes only 12 transactions, and the financial statements of most companies, even small ones, have many more transactions. However, they follow the same concepts and process. Look for future videos that continue your learning about the analysis of business transactions with the use of another tool that accountants use, the T account.